and welcome to Financial Detox. I'm excited for today's show. I'm Jason Labrum, your host, as usual, in studio with Alex Klingensmith, the greatest co-host on the planet Earth. And we are bringing you Financial Detox, how to avoid toxic advice and manage your wealth for maximum impact. We got a really awesome show today, don't we, Alex? Because we're bringing on the big hitters today. We got a big hitter guest, and we are so excited because we don't bring on guests that often, Alex, but this is a special one. We're throwing a curveball at everybody.
It's been a while. I hope we can keep up.
Yeah, he's tough. I mean, in the pre-show, I think there were several jokes that I was the end of, the butt of, and so it's going to be fun. So
it's perfect.
It is going to be fun. We're going to talk a lot today about something we do talk quite a bit about, alternative investments. And I think the timing couldn't be more perfect with all of the geopolitical unrest that we have going on in the world today. How are you going to protect your portfolio? How can you maybe optimize your portfolio from a risk return perspective? And our special guest today is Bob Long, who's the CEO of StepStone Private Wealth. And he is a special guy who has a lot to say in this area. He has a lot of knowledge and experience. And so with no further ado, I want to go ahead and bring on and introduce Bob Long. Hi, Bob, and welcome.
Thank you. Happy to be here.
So glad you're here.
I'd like to be there with you in Southern California rather than here in North Carolina, but nonetheless, happy to be with you virtually.
Right. And we were talking about that prior to the show, just what's going on in North Carolina and some of your personal passions and things that interest you outside of the financial world. Because if we only talk about financial stuff, we get pretty boring pretty quick. So we got to bring in some personal color. And my gosh, you even mentioned a family farm that's affected by the floods and what's going on. And so this is real and personal for you, huh?
It is. We were very fortunate here in Charlotte. We had inconvenience of power being out, and most of that was restored relatively quickly, and our infrastructure survived. But you go 50 miles west of here into more rural areas, which is really the foothills of the Appalachian Mountains. And the devastation is unlike anything I've seen in my lifetime. We do have a family farm, my wife's family farm. Put in a plug, Trine Mountain Farms. You can buy their products on the internet.
There you go.
Organic farm, been an organic farm for 5 generations. And my sister-in-law, Carolyn, runs it. But that area is devastated. They may not get power back for a month. And importantly, water systems, we've all dealt with loss of power from time to time, incredibly inconvenient, but loss of water systems or contamination of water systems, that will take a long time to come back. So encourage everyone to think about supporting their favorite charities, the Red Cross, et cetera, in terms of what's going on in Western North Carolina and the upstate South Carolina area.
Good. Well, we'll do that, and we'll put some B-roll or some different links in here to a couple different charities. I know I told you about my friend who's flying supplies in, and I think that's critical too, like getting bottles and or fresh waters and containers of water and different things. So there are some things to help. And that brings me to another point, Bob, that we were talking about pre-shows. Just you personally, you're an interesting guy. Not only have you...
Sometimes that's a compliment. Sometimes it's not. It's a little bit
may
like...
have meant both things right now. We'll see how this show goes. We'll see how good you are. But you have some really interesting personal pursuits. And you mentioned adoption and helping people. And our firm is one that, in Financial Detox, the show, we are all about giving back. Boys and Girls Club of Carlsbad has been a big organization for us, and Wells in Africa, and a bunch of different things that we're doing. But you spoke specifically about adoption, which I think is really interesting. And I'd love to hear more about that. Alex, what do you think? We can just go personal here, right? And have some fun.
I think it's great.
Good. Let's do it.
I'm happy to. So what your listeners may not know is it can cost $25,000 to $35,000 to adopt a domestic child. So that is and of course, then you have to rear the child and support the child. So that is an upfront sum of money that is out of reach for so many Americans. And there are thousands of families that are ready, willing, able, have been qualified by the relevant state or local agencies, and they just need money. And so I'm involved with an organization called Gift of Adoption that funds the last mile, typically the last $5,000. And so, frankly, it's something it's very easy to raise money for, because I simply explain to people with a $5,000 gift, you make a family, right? So all we do, we don't qualify people. We just take qualified people that are families that are qualified, and they need $5,000 to create a family. And I think of that as a eternal return. That's the way I think about it.
Amen, brother. That sounds awesome. And I love a statement that you said. It's not the find a child to fit the mold, the J-Lo Hollywood type of adoption.
Well, these
We're
are
talking
vulnerable
about
children. These are children that often we're able to prevent a child entering the system, entering the foster care system, get them placed with people they know, distant relatives, place them with a sibling group or a group of siblings with a family. But it's this is a problem if you can hit it at the source before people get into the system, get disconnected from a family at a critical time. It has long-term implications.
I like how you tied it into purposeful giving as part of your mix.
Yeah, that is a core value of StepStone Private Wealth is purposeful giving. And we have a lot of sayings around here, as you might imagine, but we don't love the phrase giving them money away. We really don't. We think that's abandoning responsibility for your money, treating it like an obligation or a toll you paid for the benefit and privilege of having wealth that you can invest. And so we take very seriously the obligation to manage the resources entrusted to you in the most responsible, most impactful way, the way that generates the most leverage. In fact, I'll go off script. We didn't talk about this.
There we go. I like it. We've never stayed on script.
Whatever. I keep a little lever. Like this is, you probably can't see, it's really tiny. But the idea is with what I do as CEO and what we do with our charitable dollars is to create the most leverage possible in everything we do. And having the last name Long sort of goes with creating a long lever. But Archimedes famously said, give me a long enough lever and a place to stand and I can move the world. And so that's how our family thinks about it, is trying to find the longest levers we can, whether that be in business or philanthropy, to create the biggest impact.
That's awesome.
That's awesome. There's some very good Bible verses about that too, about caring for assets and how we should be prudent and care about our assets. We talk about that a lot with clients, when a lot of times our clients have maybe more money than they need in their lifetime or they're going to spend. And so a really good question that we like to ask at that time is, so are you being prudent with those assets? So like, just because you have enough, now what should you do? That's awesome that you have an abundance of wealth, but what can you do with that to really make an impact to drive the things that you're passionate for and the things that make a difference in others' lives?
So my day job is calling on and working with financial advisors like IDA, and we do that mostly with RIAs, with independents, but that also spans to the larger platforms. So you're my clients in effect. And so I studied you. And what I find is, as a species, if you will, the best ones see financial advisory as a calling. Yeah. They really do. They do. And they recognize the impact they can have multi-generationally, both in the preservation and expansion of wealth, the philanthropic impact, and the avoidance of conflict. We all know the horror stories. Some of us have experienced them in our own families, about families who have an abundance and yet are fighting about money. There's more than enough to go around, but other issues enter it. And the financial advisor that can guide multiple generations, multiple parts of a family through that, it's really a calling, and it's an extraordinary value add. It must be fun to do your job.
It is a blast. And we see times where that impact can be so influential. Most of the time for us, it's setting somebody free, right? We call it achieving true financial peace of mind, because people of all walks of life are concerned about money. People who have it are concerned they're going to lose it. People who don't have it are concerned about getting it. People who have some but not enough are concerned about, is it going to last? And by running holistic, interactive, and I don't know if those words do it justice, I'll describe them real quick. I mean, holistic meaning that every aspect of your financial life gets put into a plan. And I talk about dynamic, meaning that plan lives on forever for your whole life. Right. It isn't something that we do a plan and hand somebody a 3-ring binder and say, okay, read all those pages. And that's old school and it doesn't work. What works is having a web-based platform where your plan is interactive. It's totally holistic and comprehensive. And this thing is a living, breathing exercise of you making the most out of your financial life. And I think where that ties into what you do, Bob, and what you're a specialist in is, yeah, there's investments and they're really important and it can make an impact in how you allocate that portfolio. But if you don't have the plan to understand what you're trying to achieve and why you're trying to achieve it, then you end up just throwing darts at a board and you have a bunch of different investments and you're not sure why. And then when they perform or don't perform, you're wanting more or less, and there's no reasoning behind it. So trying to build the foundation of why you are building the portfolio you have. And Bob, I bet you're seeing this, but I want to bring this topic up because it's heavy on my heart when you talk about helping people. One of the things that's been happening lately that I'm finding is with our higher net worth clients and higher assets under our management, they're starting to want different rates of returns than they set out wanting when the markets were maybe not so nice and the markets weren't doing so well. And they were really happy with, hey, I want a 5 or 6% conservative rate of return. I don't want to lose my money. I've got enough. And then all of a sudden now markets are just, they've been on a tear doing really great. And they're like, well, I want 10. And so my question back is why? Why do you want 10? Has the goal changed? Are we now trying to accumulate more wealth? Because that wasn't the goal before, it was to preserve. I bet you have some experience in that situation.
We do. And what we find is, and our specialty is alternatives. And let me narrow that. Sure. Alternative assets would include hedge funds, commodities, a variety of assets that are not traditional stocks and bonds, basically everything. At StepStone Private Wealth and StepStone, the broader parent company, we're focused on the private markets. So private equity, private credit, private infrastructure, private real estate. We are only the private markets, and we are all of the private markets. We are one of, if not the largest allocator to that market globally, putting out about $70 billion a year. And we're responsible for about $700 billion globally, primarily for the world's largest and most sophisticated institutional investors. 5 years ago, I led a team that came to StepStone with the idea of taking what they do for institutions and packaging it differently, and I'm sure we'll get into that, so that it was convenient for high net worth and some individual investors broadly, many of whom are high net worth, but not all of whom are now high net worth, making it convenient that institutional investment content, is the way I like to think about it, into a package that works for your clients and other clients. And so we do that because the individual investors are seeking these diversifying revenue streams, and they do it for two reasons. In one case, they want a higher return in private equity. If you're in the better managers, has historically produced a premium return. Of course, I'm compelled to say prior performance is not necessarily indicative of future performance. You must read the prospectus and consult a thoughtful, responsible, knowledgeable financial advisor. But private equity, particularly the stronger managers or the top half, has outperformed. Similarly, the diversification benefits of private assets, avoiding the dips, zigging when the public markets zag.
In the world of investing in wealth management, all the different options to do so, Bob, what was your calling into private markets?
The public markets over my working career, which now extends about 40 years, have gotten, when I was in school, you would have thought the public markets would march inexorably toward more efficiency, right? Certainly things like trading commissions have come down, trading hours have expanded, visibility, frequency of statements, all that stuff has happened. But if I had sat with one of my finance professors, or my wife went to business school, one of her professors, and said, you're going to have a multi-billion-dollar companies trading on the national stock exchanges, and their valuations are going to be completely disconnected from reality, not for 10 minutes, but for months, based on somebody's desire to stick it to the man, they would have said, that can't happen. That can't happen. And my finance professors would roll over in their grave if I explained to them that the market could be jerked around by some jerk, sometimes I use another word, who calls himself Roaring Kitty. I mean, come on. So the public markets are not necessarily more efficient. Moreover, and I've been a public company CEO twice, meaning a traded company. The funds we run, by the way, are public. They're publicly registered, like a mutual fund, and an operating company. They're 33 Act registered and 40 Act registered. But I've been the CEO of a publicly traded company in the US and one in Europe that owned assets like alternative assets, owned private assets. When I came along, a management team, that's what you aspired to do, was to be CEO of a public company, right? And if you had bold ambitions to build a really big business, you had to access the public markets because the private markets simply weren't deep enough. But what's happened over my career, public markets have shrunk. There are substantially fewer public companies today than there were 20 years ago. About 87% of companies in the United States of size and scale, 100 million or more of revenue, are private. So of size and scale, and I'm excluding my personal LLC, and Jason probably has a personal LLC. I'm talking about real companies, 100 million or more, 87% are private. So the public markets, if you stick only the public markets, you don't access so much of the economy. Those markets can be jerked around by irrational actors. Meanwhile, the private markets have grown vastly. They've specialized. And in many cases, they are financing the real economy. You guys, I'm sure, tell your clients all the time, and you can explain better than I, how 6 or 7 public stocks, largely tech companies, move the public markets and drive and control the public markets or control the returns. So for all those reasons, I started getting into the private markets about 20 years ago and have continued to build out my career. You know, there's another piece, I think, of what you asked. When we started StepStone Private Wealth, it was the goal of expanding access to institutional caliber private assets in a form that was convenient, efficient, and transparent. So there was a calling aspect to this, and we're thrilled that we've been able to raise we've raised about $4 billion, and our assets are substantially higher than that, given the returns that we've generated. But we've been able to do that with thousands of investors and giving them access to products we're very proud of.
And that's changed, Bob, right? I mean, when we look at what has happened, if you just go back 10 short years, the types of differentiated investments that people can put in their portfolio, we always talk about mass affluent and high net worth. That's our target market. And just as for our listeners, mass affluent is 500,000 to 2 million investable assets. That's what we coin it. High net worth is 2 million to maybe 10 million investable assets, and ultra high net worth starts getting higher than that. But those investors did not have access to these types of portfolio differentiators 10 years ago. It was very difficult. And if you did get it, it was a one-off single investment in a 10-year type of drawdown product with a K1, and it was very messy. And that's not the case today. We talk about this all the time. We can use different investment vehicles from StepStone and others to round out a client's portfolio and create a different risk return profile.
And the convenience factor, the point you made is critical. So those traditional drawdown funds that were designed for large institutions where you are committed, but not necessarily invested. So you take a large California state pension plan, for an example, makes a $100 million commitment to a well-known LBO manager, one you see in the paper, KKR, Apollo, Carlyle, pick any of those great managers. This is just an example. Well, that money is called down on an unpredictable schedule over 3 to 5 years, and then comes back over another 3 to 5 years in a somewhat unpredictable pattern. It's hard for individuals to manage that cash flow. It's hard for individuals to get to their target return. You talked about the financial plan. Imagine you work out with that $10 million investor that they want to be 1 million, 10% in private equity. Well, if you're committing to a series of funds, maybe, frankly, the minimum for those drawdown funds is probably 250,000. It may be higher, but I'll for those, you're just really going to have a hard time getting to your desired outcome. Yeah. But what's really happened, and it was starting before the financial crisis, that put everything on hold for a while. But starting in the late teens, and we launched our funds in 2020, you've seen a series of evergreen funds that operate like mutual funds. So investors typically accredited and up, so 1 million of investable assets and up, generally. Some are offered for investors that don't have 1 million of investable assets. But typically for accredited investors, they can commit all of their capital up front at one time, send that capital through their financial advisor into the manager, and then they're fully invested. The minimums are typically low, $25,000 to $50,000 minimums. You can add to that on a daily or monthly or quarterly basis, typically daily or monthly. In small minimums, maybe another $5,000. And so you get invested, you stay invested, you get a valuation promptly. You get, at the end of the year, you get a 1099 like a mutual fund, and you get it in February. If you're in a traditional drawdown partnership, you're getting a K1, a partnership tax return that's many pages, and you're getting that, if you're lucky, in September. So you're having to amend your tax return, et cetera. I think people are generally familiar. So the benefit of evergreen funds are for individual investors, you get invested, you get frequent valuations, the minimums are low, and you get access to diversified portfolios. Typically those, well, you get access to an on-the-run portfolio. If you invest in any of our funds today, or I know you have some very fine of our competitors on your you offer them.
Yep.
You're investing in an existing pool. You don't have that blind pool risk. You're coming in just like if you were to buy a mutual fund. It's 3:00 in Charlotte today, right now. If I put in an order to buy a Fidelity mutual fund, right, I'd come into that fund tomorrow morning at a new price. I would own a little teeny piece of all the existing companies. This is the same way. It's just like a mutual fund. In fact, it's regulated like a mutual fund with an independent board who reviews our fees, an audit, an SEC process, et cetera. So that, people talk a lot about the democratization of alternatives. I believe we're beyond that. I think we're in the institutionalization of the democratization. Mm-hmm. So the products today are actually high caliber and easy for clients to use.
We've experienced it and we've been talking about it. So it's really fun to have somebody like you who's at the core of these products and how they're being built and how they're being delivered. And we are working diligently to find the right providers and builders of these products. And we're taking it another step because the issue that happens for advisors, and I think you may know these numbers of adoption rates. When we look at 9 out of 10 prospective clients coming to our firm have zero alternative exposure. They are significantly lacking in what they could be doing from a risk return profile in their portfolios. And that to me is amazing, Bob, that people still aren't doing it. But then I turn around and I see our firm and I see the administrative complexity and burden of trying to get 1,000 clients allocated appropriately. So I don't want to talk about the details of what we're doing, but we've built and we're in the process of building a solution for that for our clients so that the portfolio can be effectuated immediately. It can be radically diversified and it can do all of the things that we want to do for our client without being slow to get it done or administratively burdened. So that allows us to have more time to do more work for our clients and do more good for our clients. But what would you say? Are the adoption rates as low as we're seeing of alternative assets in general? I mean, it's still really in its infancy getting into retail regular investors, right?
100%. So even at the largest and most, well, we know all the platforms and I won't name names. The rates are low and the goal of senior management at those firms is to double and triple.
Yeah.
And so in terms of the independent channel, the RIA channel, your experience is very typical. In fact, I think you're ahead of many of your peers. Your understanding level is certainly well ahead of many of your peers. And I will meet with financial advisors. I met with an RIA recently who said, Bob, my clients aren't asking me for private assets.
Of course they're not.
And I politely thought, you're charging them your fee for what they ask you for? Right, you're not coming to them proactively with ideas, best in class, based on your experience and your team and your research. Okay.
Yeah.
The question that comes to mind, Bob, when you share that is, so the core to the theme of this show, Financial Detox, is trying to help people, investors, and even advisors ourselves to avoid the mistakes people make. What are some of the mistakes that we as advisors or investors too should avoid You've been through probably a couple in those years of forging this path for all of us to benefit from. What have you learned that we can learn from? And also what, if you don't mind sharing maybe what you think is coming now that we should also be aware of as investors, right? In the private markets.
The theme of everything you guys have said is why, right? You guys are why people, and your firm is a why firm. So I would start with, if I'm a client, Jason, why are you recommending alternatives? Yep. And the answer should not be because it camouflages hidden volatility, which is the way some of these products were sold 10 years ago. You were alluding to that earlier. Mm-hmm. We don't do that. We seek to present the most regular and frequent and most accurate valuations we can for all our assets. So a mistake is to try to hide volatility, and some financial advisors do that, and I recommend against it. The second thing, though, gets into, if I'm your client and you recommend an alternative asset, I'm going to say, tell me why I should take on the complexity. Tell me why I should take on the illiquidity. And you need to be able to justify that. And the right answer is because the product or firm or fund I'm recommending to you, Bob, has historically generated premium returns and provided diversification benefits that reduce your risk profile. And then, of course, you need to go to the next layer of that. And we've hit on some of those statistics. We can go down that further if you want. But that needs to be the answer. The answer, and then the hardest question, I think, and the one I would leave your listeners with, like the key question is, Jason, you've recommended this product. Tell me why there isn't a public market substitute that's just as good. And frankly, the answer for that in a private equity fund is easy. There isn't. In the case of private infrastructure, at least in the United States, there really aren't. The public infrastructure, there is traded infrastructure, but it doesn't behave like private infrastructure. In the case of credit, the answer is more nuanced. There are publicly traded business development companies. Some of them are great. In the case of the credit fund we offer, we have a differentiated exposure. We have exposure to buying assets on the secondary market, not just direct lending, of which there's plenty of stories about, so I won't go into that. I think everybody is familiar with that. But we add to the direct lending strategy, buying assets on the secondary market, typically at discounts to net asset value, and also specialty credit, investing in what we believe is the next big arbitrage opportunity. Direct lending and private credit has been driven by the banks pulling back from more highly leveraged lending, or the lending specifically to private companies and private equity LBOs. And private credit has filled that void, and it's worked very well today. Very, very well for both StepStone investors and the broad market, of which there are many, many products. But that market, for example, we think is a $3 trillion market. We think there's $1.5 trillion to $2 trillion of dedicated fund capital lined up against it. So still a very interesting opportunity. The specialty credit market, we think, is a $20 trillion market.
Wow.
And we think, our research, we think there's about $500 billion of dedicated capital. Wow. So we think, and banks are pulling back from that. So we think that's a really interesting opportunity. And the credit fund we've brought, called CredX, invests not only in direct loans, but also secondaries and also specialty credit. So again, you've got to ask your financial advisor, why shouldn't I buy a public BDC? Why should I buy CredX, our fund, or many of the other? I know you offer your firm some other very good credit funds. Finally, real estate. Real estate has always been the asset class that is probably the best understood within private assets. Yep. It's been first, the institutional caliber non-traded REITs were some of the first high quality products brought to the market, and they've grown really rapidly. We all know the brand names. But the challenge they faced with redemptions is driven largely by the fact that investors look at their portfolio and believe they can buy a similar asset at a lower price in the public market. By the way, I have no opinion about whether those investors are right or wrong.
Right.
I mean, I would tend to bet on some of those high quality managers that have gotten a lot of negative headlines. But the difference is when you're talking about buying apartments and warehouses, you can go to the public markets and construct a similar portfolio. So big picture, try to summarize that. When your financial advisor recommends a private fund, even an evergreen fund, and I didn't mention, these evergreen funds do have regular liquidity. They have the ability to exit regularly on a quarterly basis at 100% of NAV, typically for 5% of the fund.
Yep.
When you're taking on some illiquidity and some complexity of an evergreen fund, what are you getting for it? And it needs to be differentiated investment strategy. And anyway, that's what we're offering, and we believe that's critical.
Thank you.
I think we may need to come back to that on another show and unpack the specialty credit, because that sounds very interesting when you talk about a half a $1 trillion allocated to a potential $20 trillion market. That's ground level stuff, which is awesome to be in on. I think we got, I'm not sure our listeners are going to grab everything we're talking about, but I think what's important is that they understand these are the types of conversations that we're having, that a good fiduciary financial advisor should be having. They should be talking about these things behind the scenes and doing the due diligence and pursuing better for you. And then they should be bringing these thoughts and ideas to your portfolio. And history says that we can increase the risk and return or improve the risk return profile of a portfolio by adding these non-correlated assets. And we'll show some slides to that, and we'll make some links available for that kind of stuff too, to see. But this is where I think conversations matter, personal relationships matter, having a financial plan, but having somebody to really unpack your goals and objectives and what you want to accomplish. The stat that you talked about, Bob, is so big with how we talk about this all the time on the show too, is how I think it was almost 15,000 publicly traded stocks with 100 million or more that has gone down to just about 4,000.
Yeah.
Meanwhile, the numbers you gave on private equity. So you look at where is just the investment universe and the opportunity to go capture returns in a better way. And it exists largely outside of what everybody knows as stocks and bonds. So, but it's complex.
Why is that though? What causes that shift?
Couple of things have happened. So Sarbanes-Oxley and other regulation has made it harder and less to be public. That's the negative side. The positive side is the private markets have grown to be able to support. So let's use an example without exactly naming a name, even though you're in Southern California. Imagine your business plan were to build rocket ships, right? What could be more capital intensive than building rocket ships? 20 years ago, if your business plan was to build rocket ships, there was no way you could possibly envision that without accessing the public markets. You just couldn't create the capital, right? But today we have the leading rocket ship company, SpaceX, that has not accessed the public markets, but instead has accessed, according to public sources, a dozen or more rounds of private venture capital funding and raised over $10 billion that way. And you couldn't have done that. That capital didn't exist in sufficient scale and depth. Moreover, private equity managers in particular have gotten very specialized. So now there are groups that focus on aerospace defense, that focus on biotech. And at every stage, you've got seed investors taking high risk, seeking very, very high return. And you've got later stage investors that will come in right before a company goes public and earn what they with the target of earning, a substantial return over public markets, but not the extremely high returns that you should earn if you're successful with a seed or a seed stage, early stage investment. So sector specialization and then stage specialization overlaid with geographic specialization has led to a more efficient market that supports entrepreneurs in a way that works.
I describe it as the funnel approach, right? You look at a funnel and the top of the funnel was what used to be innovation and new productivity and new ideas and thoughts that needed capital, and they would go to the public markets, but they're not going in the top of the funnel anymore. They're just going to the private markets for that funnel. Yeah. That's why you've had this massive reduction of publicly traded stocks. And to deal with the reporting requirements and the filing and all the different additional bureaucracy to have a publicly traded company versus a private company is lending itself to this. I think we're really in the beginning too, like we said. So Bob, you added a lot of thoughts. We're going to dig deep for some good content and some visuals to add to this for our listeners. It's been great to have you. We're honored to have you on the show. And as a resource available for our firm, we talk about when building portfolios and helping people get financially detoxified. We talk about going to firms like yours, showing them what we have and asking you to break it. And we do that with big names, StepStone in private markets. We do it with BlackRock. We do it with Goldman Sachs. We do it with JP Morgan. And we say, break our portfolios and show us what we're missing. And that brings to our clients not only the collective knowledge of our own human capital, but yet the collective knowledge really of some of the greatest thinking and sharpest minds in the world when it comes to investing and building portfolios. So to be able to have you on the show is an honor. We love it. I know we could go on for probably another good hour or two talking about this and unpacking it, but I think we'll have to save that for another show. Thank you for being here. And for all of our listeners on Financial Detox, we just appreciate you being here. We hope that this information is valuable for you. And the best way to take action is to get in touch with a fiduciary advisor. Of course, our IDA Wealth firm can help you with that. And you can get us at financialdetox.com. And you can check out our show on YouTube or anywhere. We love you're listening to it. And we hope we are providing you with great information. Alex, any other closing thoughts before we wrap?
No, I learned a lot today. I usually talk more, but thank you, Bob. I come away smarter, I think.
Thank you.
Alex is so good at asking the questions, so it's weird when he doesn't. I like when you do, Alex. Bob, any closing thoughts for us?
Yeah, I would say two things. One, the great thing about Evergreen Funds is they're public. Like, we are publicly registered. We're not traded.
Yep.
So all the information about our performance, our portfolio is on our website. So you can access that at stepstonepw.com or through your financial advisor. And the last thing is, this is not a do-it-yourself, right? We do have some friend and family investors that come to us directly, college roommates, et cetera. But it's really, really critical to maximize the risk reward in your portfolio, to work with a highly experienced financial advisor and work with someone who does not have a conflict of interest, who really is a fiduciary, period, full stop. And so encourage your clients to really think, or prospects or listeners, just to think really hard about that as they make their decisions.
Thanks, Bob. It's great for them to hear that from somebody besides Alex and I on a regular basis, but it does matter. Advice matters, and not all advice is created equal. It's Financial Detox. I'm Jason Labrum, your host. We appreciate you tuning in. We'll have another great show coming up here soon. Thank you so much for listening, and we'll catch you on the next one.